Welcome everyone. Greetings from New York City and Columbia Business School Executive Education. My name is Stephanie Boyd and I'm very excited to welcome you all to the third out of 4 webinars we are running over these 2 days. And a very special welcome to the attendees of the 2018 Association for Talent Development International Conference and Expo in San Diego who are watching this over live stream. Before we get started with today's webinar, How Corporate Culture Affects Business Outcome with Professor Shiva Rajgopal, I would like to go over a few brief logistics. First, a recording will be available following the conclusion of this webinar. Second, if you'd like to tweet about the webinar, please use the hashtag CBSExecEd. Second, finally, we encourage you to ask questions during this webinar using the Q&A box. During the last 10 minutes of this webinar, we will answer as many questions as possible. So, Shiva, it's great to be with you today. Shiva Rajgopal is the Vice Dean of Research at Columbia Business School and is the Roy Bernard Kester and T.W. Byrnes Professor of Accounting and Auditing. Among his many areas of research include timely topics such as corporate culture, financial reporting, executive compensation, and corporate governance. Shiva, I'll turn things over to you.
Thank you, Stephanie. Good morning, good afternoon, wherever you are. So I'm going to talk about how corporate culture affects business outcomes. And virtually every conversation I've had with CFOs and CEOs in the last 10 years always comes back to this notion of culture, notion of tone at the top. So we conducted a fairly extensive study covering about 1,000 executives to understand what is culture, how to think about it, how might it affect business outcomes, and I'm going to share some highlights from that study in the webinar to follow. So culture is always an interesting topic. You know, you open the newspapers and you see scandals virtually every month, I want to say. You know, the Volkswagen scandal, the VA scandal, the Firestone problem, and there are so many. But maybe Wells Fargo probably is the Enron moment of corporate culture, in the sense that they've already paid a $1 billion fine to the OCC. There's a new $185 million fine, and now they're being sued again for selling insurance that people don't need. So I'm going to use Wells Fargo as a case study to illustrate the principles that they seem to have violated when it comes to organizing their culture, their compensation scheme, and so on. So most academics like to start with a framework. Now this diagram looks a bit intimidating, but it's one way to conceptualize what culture might be. So if on the right, which maybe your left, think of a few formal corporate institutions. So what I have in mind are things like the board of directors, compensation schemes, hiring and firing practices, and so on. So these are the formal institutions that often get studied in trying to explain business outcomes. And they could be as varied as innovation, compliance, creativity, productivity, and so on. What we are adding to this setup is this notion of culture as an informal corporate institution. So if you think about what might the definition of culture be, it might be something which you do when no one's looking. You know, there are no explicit rules. It's almost a coordination mechanism that binds the employees together and tells them what they should do when there are no explicit rules, right? So to make it a little more formal, you can think of corporate culture as falling into 2 big buckets, values and norms. Now, what are values? So values are these, motherhood and apple pie statements that you see pretty much in every corporate lobby. So they'll say things like, we value truth, integrity, respect for minorities, respect for the environment, and so on. But norms, on the other hand, is how the company actually walks the talk, meaning what does it actually do to bring these values to life? And as you can imagine, these two have to gel and intersect. and to the extent they don't, you get an ineffective culture and bad outcomes. And this goes to pretty much every formal institution that we can think of. So does the board do enough to make sure that the values and norms gel? Do the compensation plans claim that they reward values, but they actually reward something else? So you'll see examples where Wells Fargo seems to have somehow not gotten this convergence between values and norms correctly. And hopefully when they go about repairing their culture, they'll get this intersection right. So I'm going to show you a series of statistics which we gathered from the study to try and tell you that people really think culture matters. So 91% of these executives we talked about said culture is either important or very important at the firm. About 80% of them say culture falls in the top 5 of the things that make the company valuable. And they've chosen culture on top of other things like, say, brand, financial health, leadership, market position, operating plan, and so on. So, 92% of them say that improving the culture will actually increase firm value. Why is this interesting to us? Most economists in general tend to focus on things like capital, labor, say capital structure, or the financing characteristics of the firms as first order drivers of value. We in general tend to not look as much at these informal institutions. So the big takeaway from these results and this slide is that culture is a highly underappreciated economic asset that drives firm value. And now let's look at a few specific actions affected by corporate culture. So the big thing that often comes out is this problem with short-termism. So in general, managers have short horizons, so they tend to do expedient things that get them through the quarter or get them through the year without thinking as much about how these actions affect firm value. So to tease this out, we set up an experiment where we come up with a hypothetical project that we show these executives. So project 1 is quote unquote the myopic project, where in the first year or two you see positive cash flows, but then the total NPV or the net present value of that project is much smaller than, say, project 2. Now project 2 is a case where you see negative cash flows early on, but you end up seeing hugely positive cash flows later. So the idea is to create a tension here in trying to figure out how many of these executives would pick project 1 as opposed to project 2. And we find that about 60% of the executives end up picking the myopic project, or the bad project. And when we probe deeper, it turns out that culture is a big factor that drives this this selection. So some of them told us things like, culture is this safety blanket that helps us get through the difficult short-run times, and we keep our eye on the puck and keep trying to maximize firm value. Ethical choices, this might be somewhat obvious. 85% of them told us that an ineffective culture increases the chance that the employee might act unethically or even illegally at times. Earnings management. So this is something that you see every earnings season, every quarter. Companies are very creative about nips and tucks, trying to make sure that they meet analyst forecasts. So when we talk about earnings management, 53% of our executives told us that an effective culture reduces the tendency to play these earnings games. So in terms of pitfalls, what should you avoid doing? So, a lot depends on, say, the tone at the top or the tone that the leadership sets. If the leadership cares more about the end result and less about the means of getting there, then you're likely to get a culture that's prone to short-termism. Interestingly, many of these CFOs told us that the stock market does not give them enough credit for the culture investments that they make. So this may be a reason why, although culture is hugely important and adds value, we find that not all firms necessarily invest the appropriate resources to develop their culture. So if you talk about specific interactions here, things like learning. So many of them told us that you want to build an environment or a culture where failure is actually used as an opportunity to learn, as opposed to effectively killing the messenger. So if you have a culture where you end up penalizing people for failures, very soon people will stop taking risk. So to have these big successes, you have to be able to tolerate big failures as well. The other thing that often came up while discussing interactions was this notion of urgency. So most of us have been in meetings where people talk around the elephant in the room. They debate these peripheral questions without actually getting to the core of the problem. So when you set up meetings, you want to watch for this tendency to actually pussyfoot around the core issue. Critiquing, this comes up a lot. So do employees feel empowered to be able to at least speak up and point out issues against their immediate supervisors or even against senior management? Now, Wells Fargo is a good example. Several employees actually blew the whistle on the practices that Wells Fargo was following right up to the board, but nothing got done, and in a couple of cases, these employees got fired. In fact, I'm reminded of a very exciting research study which points to the importance of critiquing and whistleblowing. So the context here are these, I think, Boston and Maryland hospitals where nurses would often not have the courage to speak up against the surgeons, and especially in these ICUs, these intensive care units. So the nurses eventually came up with a checklist to make sure that the surgeon actually, say, washes hands, changes gloves, and so on. And infections in the ICU actually fell by 30%. So this is one way to create a mechanism to empower people below, in the trenches, to be actually able to speak up and at least nudge senior management to do the right thing. Compensation. Now, this is a big factor. We heard lots of interesting comments about compensation. So, some of these executives told us that if compensation is not aligned with the culture, it will end up changing the culture. Again, Wells Fargo is a great example of this problem, because if you remember in the Wells Fargo case, every salesperson had to open 6 other accounts or 6 other transactions with the customer. So this could be a checking account, a savings account, a deposit box, a credit card, or something else. And it's really hard to do that in today's world because nobody actually goes to a branch to do banking. So if you're a retail customer, more often than not, you're probably transacting on your mobile device. So if you set up a system where people are rewarded for something that's very hard to achieve, they'll end up doing the wrong thing, and that'll eventually end up changing the culture of the institution. Stack ranking. Now, you see this a lot in many companies. The idea that if you happen to fall in the bottom 10%, you automatically get fired. Guess what happens? If you practice stack ranking, you're effectively setting up people against each other, and they don't cooperate, and very soon it becomes a dysfunctional, poisonous environment to work in. This is another example where Wells Fargo seems to have failed. So if you mechanically pay people off metrics, you get what you measure. And I see this all the time in my classroom. If I set up a grading scheme such that I make sure everybody attends, yeah, they physically show up to class, but they're mentally somewhere else. So it's very hard to set up an incentive scheme where you make sure that people don't game the system and actually do the right thing for the company and sometimes even for themselves. And finally, this notion of watch who you promote and who you celebrate. Companies are very good at telling people we value X, but they end up promoting people who pretty much embody the exact opposite of the so-called value system that they want. Another example in the Wells Fargo case, the head of the retail bank who was deemed responsible for the scandal was fired, but she got a $125 million severance compensation. Now, what does that tell you? It's a classic example of saying something and doing something else, which kind of goes back to our values and norms integration idea that I talked about a couple of minutes back. So just to wrap up, a few final takeaways from this extensive study. Culture is a very important, underappreciated economic asset of the company. Not enough attention gets paid to it, sometimes at the board level, when you set compensation schemes. the way you organize your workflow, the kind of people you hire, the kind of people you try to retain. And the one big takeaway with culture is that you have to walk the talk. If you put out these, cultural values, designing your organization through, as I said, workflow, hiring, firing, compensation schemes, the focus always has to be on actually translating these values into practices, into norms. Only then will you get all these effective outcomes in terms of productivity or innovation or good financial reporting practices. And as you can see, as we discussed throughout the webinar, Wells Fargo seems to have failed to internalize some of these key ideas. So I hope you have lots of questions.
Great. Thank you so much, Shiva, for your insightful talk and for a lot of great examples. So we've had a couple of questions come in. This is from Eric. What is the single most impactful way to change corporate culture?
That's a great question. It all comes down to tone at the top. There's this old Russian saying that the fish starts rotting from the head. So unless there's a real commitment from senior management and or you have new management come in, it's very hard to change culture. It's all about leadership.
Great. And then a follow-up question to that is, how do you bounce back from one of these big public failures such as Wells Fargo had?
That's again a great question. So people have studied that, and the important thing to do is to come out and actually say that you're guilty. Don't listen to the lawyers, because they'll try to make sure that you don't go and say these things in public. But that's pretty much the only way to actually build trust with your stakeholders. And then you have to work aggressively to not only keep the capital market happy in terms of, say, governance changes, firing managers and so on, but you have to make sure that you mend fences with your entire set of stakeholders, whether it's employees, whether it's the town or the municipality you work in. Effectively you have to reset, communicate that the past is behind you, bad things were done. A good example of a company that's actually managed this turnaround is Volkswagen. So Volkswagen had as you remember, the diesel emissions scandal, where they were actually fudging the tests to make sure that the emissions actually looked acceptable, although they were not. But then if you look at the latest quarter, Volkswagen has managed to record a huge bump in sales. Partly aided by the German government, because it's almost one of those employers that's almost too big to fail in Germany. But that might be an example of a company that's actually come back pretty well.
Great. So we have another question from Ginny. Can you share how companies are measuring against the values to indicate whether they are winning or losing in the desire to establish a positive corporate culture? So before they fail, how are they doing measuring up?
This is a great question. I mean, you can think of, to make this a little more concrete, in the context of banking. So the Fed has been pushing the big, too big to fail banks, if you want to call them that, to try and fix culture. Because the Fed is convinced that if they had better culture, then the negative outcomes that happened during the financial crisis might not have happened. Especially because financial literacy in general is pretty low in the country. I remember reading a statistic that barely 30% of educated people understand compound interest. So most of us sign contracts that we don't understand. When was the last time you read what Apple said before you hit I agree, or you looked at a lease contract? So it's very easy in the financial services world to structure transactions and sell services that you may not actually need, and to charge you for those services. So how have the banks managed to measure whether their norms actually line up with values? It's difficult. Measuring culture is so complicated. One of the reasons why economists have pretty much left culture alone is this difficulty of measuring things. But from what I understand, they run a series of standard HR surveys. But the interesting thing that I learned, though, is that they also have these instant polls. So it's like Pulse, where they'll send you a one-question survey in the morning. How do you feel about X or blah? happy smiley face, sad smiley face, whatever, hit the button. So constant polls help in terms of getting a feel for the temperature of the workforce in some sense. And then for deeper issues, you have quarterly surveys or annual surveys. You have to encourage people to come forward, so set up active whistleblowing systems. And when people actually file a whistleblowing complaint, it's very important to make sure that you actually take that seriously, you investigate, and you go back and communicate to the employees that something was done. Because more often than not, the people in the trenches know, and they, despite the difficulty associated with whistleblowing and speaking up, they usually tell someone something. It's the classic, what you see in the New York subway. If you see something, say something. So people do say stuff, except it doesn't get acted on. And once they file a whistleblowing complaint and nothing gets done, partly because management thinks that this is frivolous, or people just complain and they look the other way without looking at the signals, then they lose interest, and they indeed look the other way, and things carry on before they come to a head and a crisis erupts.
Right. Well, kind of, I guess, in line with that topic, we have another question from Stefan, who says, if the fish rots from the head, then how does the company hold leadership accountable? If leadership doesn't walk the talk, then how do we fix it? How do we address it if they ignore the whistleblowers?
Well, somebody has to step in. It has to be the board. Sometimes when it gets to be a public scandal, then the market disciplines you. Short selling goes up, analysts get more intrusive, and I start asking bonehead questions. That's a reference to the Elon Musk conference call. So how do you fix it? There might, if the board actually starts doing its job, that's one way things could get fixed. If maybe sometimes you can have an activist threat. An activist shareholder comes in and tries to replace management, tries to probably buy the company at a depressed lower price, and then fix. But it's complicated. It has to be a takeover threat if it is from the outside, or if it has to be something from inside. The board has to realize that things have gone bad. Sometimes it's the threat of regulation, or probably a massive lawsuit. So you almost need an external crisis, unfortunately, for things to get fixed sometimes. And it's that old cliche: you don't want to ever let a crisis go to waste. So perhaps that's the only way.
Great. So we have a couple more questions on, this is from Shola. What sort of checklist would you recommend to a bank executive to nudge the management or the board to change the culture without butting heads?
That's complicated. I mean, I love the ICU example. It's probably much easier in the medical world, because there's a lot of science behind this whole notion of hygiene, and the steps you probably should take. Simple, small steps that often get ignored. Finance is far more complicated. In fact, I've heard Nobel-winning physicists argue that physics is actually easy because they don't have to deal with human beings, as opposed to finance and economics. So that's a tough one. I think it's if you could come up with a product like that, I'm sure it'll get picked up and be very popular. Speaking up is generally hard.
Yeah.
I mean, if you just project back to your to your days in your company, or when you're in the workforce, many of us have seen things that are small problems, padding receipts, and in our context, sometimes students cheat, but it's almost easier to look away than to surface the problem, go through the process of actually fixing things. And these are the kind of employees that you actually want to encourage. On the contrary, being a whistleblower is socially very hard. If I've looked at some data where we find that most whistleblowers end up in a divorce. They are financially worse off than they were before. They are by and large unemployable. because people think that you're a snitch, and nobody in the whole industry touches you. And if you ask them, will you ever do it again? 9 out of 10 of them will say, I'll never do it again. So speaking up is very difficult. It's a problem that serious companies need to have a conversation about. It's almost as big or similar to the whole Me Too movement. Did anybody speak up for so long? So now there's enough social momentum to come forward. That's when you see some of these scandals erupting. So a serious, proactive company would actually have these difficult conversations inside and come up with processes, which may not be easy to replicate across companies. So, it may be hard to come up with this one checklist, unlike the medical world, because it's very context heavy, and so these are things that companies can pretty much only do for themselves. And it's somewhat hard for outsiders to come in and actually prescribe a checklist.
Great. So I guess we're talking a lot about disaster and how to kind of bounce back from things that have gone wrong, but what if your culture is not broken? What if things are going well but you want to enhance it? How do you design a business case or a way to implement enhanced corporate culture?
Well, if things are going well, you're in the minority. I didn't present some data here, but when we talked to CXOs, broadly defined, the lowest level we talked to were divisional managers, and we asked them, do you think your culture is close to where it should be? And only about 30% of our respondents told us that the culture is close to where it should be. The other 70% claim that there's at least some room for improvement. And some of the data we have from the other 70% is just fascinating. People complain about all kinds of things, unwillingness to take decisions, nepotism, postponing the inevitable, going through the motions to convince yourself that progress is being made without actually making progress. So if you're in the lucky minority and if things are going well, advertise it. We can probably learn from you. And some self-analysis for why things are working well would also be interesting, because by and large this is a fairly under-researched area, and discovering what works is probably as important as discovering what doesn't work.
Great. So we have time for one last question, and this is from Fernando again. How do you analyze the differences between corporate cultures throughout the world? So you referenced Volkswagen, you referenced Wells Fargo's. Fernando specifically asking about Brazil. Are Brazilian companies so different in culture from American organizations? Is it because of the main cultural differences across the countries in general, or how would you kind of answer that?
This is an excellent question. So we deliberately restricted our sample to North America, Canada, and the US for the obvious point that you want to keep the underlying social dynamic by and large constant. Otherwise, you're turning too many dials. It's kind of hard to do science when you're turning too many dials. But this is a great point. A lot depends on the state of your macro institutions. I'm watching this, should tell Fernando, the fabulous Netflix show called Mechanism. I'm sure he knows that. It talks about the corruption culture in Brazil, and it's very similar in India. So it's very hard to be good in a sea of evil. You almost have to best respond to what your macro institutions and your country culture is like. But there are examples. I don't know enough about Brazil, but I can give you an India-based example. So there is this company called Infosys, which is in India a very clean company, and their comparative advantage is that they never do anything questionable. They always do 2x better than what an American company would do in, say, appointing independent directors, empowering employees. So it's an opportunity. You can actually distinguish yourself as a stellar company, especially when your competition is not that stellar in terms of ethics and in terms of actually walking the talk.
That's great. So if you have a lower bar, you have a chance to excel even more.
Well, that's an opportunity, exactly. Yeah.
Well, thank you again, Shiva, for your great webinar and for all the great questions. Thank you, everyone. Your questions were coming through, and we hope that we answered a number of them. And, thank you again, and please leave your comments and feedback, and we hope to see you all soon.
Thank you.